Okay, are you ready for Chapter 4? I sure hope so. I hope that you have a good grasp on basic accounting practices and creating financial statements. You're going to need it so much from this point forward. If you have any questions at all, please let me know. All right, the learning objectives. This chapter is different. Up to this point, we have studied service companies, companies that provide services to their clients, accountants, hairdressers, lawyers, medical facilities. In this chapter, we're going to start talking about a merchandising company, a company that sells product to other companies and to the consumer. So we have to learn some new accounting concepts in order to be able to account for those sales. So we're going to be looking at both the purchase of the product and then the sale of the product and all the things that go along with that. And then, of course, at the end of the chapter, we're going to look at ratios and ways to do analysis on those numbers. So let's get started. All right, as I mentioned, a service business involves making revenue from providing services. A merchandise business, on the other hand, buys product and then resells it. Their financial statement will look different. On a service business, we had fees earned and then our expenses to get to net income. And something I'd like to mention here, the title of your revenue accounts. Those vary from business to business. Some service businesses use fees earned. For my company, I like to be a little more specific about the revenue stream. So I have a revenue item that is titled income tax revenue. I have one that's titled accounting revenue. On the merchandising side, they often use sales as their title, but most companies, again, will become more specific. Let's think of a department store. They may have a clothing sales, a home goods sales. So those titles are not set in stone. They are titles, the account titles are often developed by the company so that they can get a better picture. So don't ever be stuck on a name. In the merchandising business, you'll note that we have our sales and then a new line item called cost of merchandise sold. Most companies call this cost of goods sold. Then there is a line for a total, and we have a new total. We have gross profit, then the operating expenses, and then the net income. There's a reason for this. In a service business, you have to make enough in revenue to cover your expenses. In a merchandising business, we have one expense that has to be covered immediately, and that's the cost of the product we're selling. Then we have to make sure we've made enough gross profit to cover the rest of our expenses. So this is a new format that we'll see as we look at financial statements. So before we get into the data entry for purchases and sales, let's look at an income statement for a company that sells products. You'll note it looks a lot different now. It's a whole lot more detailed, and it's called a multi-step income statement, as our balance sheet that we looked at in the last chapter became a multi-step balance sheet. That's because there's different sections, so it has expanded. You see at the beginning we have our revenue, and then we have a section here that says less returns and allowances and less sales discounts to get a net sales number. So you'll see there are more columns on this statement now than we had in the past. Then we have our cost of merchandise sold, or cost of goods sold, and our gross profit. And even the section on expenses is different. We have first the selling expenses. These are things that can be directly tied to the cost of selling our product. Then we have a section for administrative expenses. These are general expenses that are throughout the company. And then we have total operating expenses and our income from operations. And as we saw on a financial from the last chapter, I believe, we have this section for other income and expense where we show rent revenue. That's not something that's part of their operations. We also show interest expense so that we then come down to our net income. That way the company can distinguish what income, what is their profit strictly from operations, and then add to that either the profit or subtract the loss from other things that the company may be involved in. Looks a little complicated, but I'm sure you'll get it. Now, we all know that a company that sells product is often going to have returns. Sometimes you buy something and you just decide you don't want it, or it's damaged and you return it. I know I have 2 items in my car right now that I need to return. Well, we could just deduct that from sales, but companies like to have the ability to see exactly how much is being returned so they can track the reasons for those returns. There's 2 types of inventory systems that we'll learn about. One is a perpetual and one is a periodic. We'll learn more about that. And as I mentioned, we can see the profit or loss strictly from operations before addressing any other items. In a periodic inventory system, the computation for the cost of goods or cost of merchandise sold is a little bit different. We look at our total merchandise inventory. We look at what we had in the beginning, how much we've purchased, any purchases, returns, and allowances and purchases discount to find our net purchases. We add to that our freight, and then we have the total merchandise available for sale. Then we have to take an actual inventory to determine what we have left in order to determine our cost of merchandise sold. In the other type of inventory, a perpetual inventory, every time we have a sale or purchase, we are updating our inventory and updating our cost of goods sold. In the periodic inventory, we're only updating those items periodically. How'd you like that? Some companies will use just a single step income statement. It does not give nearly as much information. It's very simple, and only, generally speaking, very, very small companies, merchandising companies, would use this type of income statement. The retained earnings statement looks just the same as it always has. and our balance sheet. The only thing different on our balance sheet at this point is a new line item that is merchandise inventory. You can see this is still the multi-step balance sheet so that we can see current assets, we can see current liabilities, we can see numbers that we need to do our analysis. The statement of cash flows still looks very similar. No major differences on this. And an example of how they're integrated, which you've become familiar with. How each item relates to a different financial statement. So let's look at how we sell merchandise. The first part we know. We have our sale, and we're going to increase our retained earnings. Do you see this $1,800 here in retained earnings? Increase our sales and increase either our cash or accounts receivable, depending on how it was sold. But now we have this extra piece. We have to do something with the merchandise that we sold. We have to get it out of inventory and do something else with it, because we know that it must balance. Every entry must balance. So the cost of this merchandise was $1,200. So we'll reduce our merchandise inventory by the $1,200. That becomes a deduction on our retained earnings, much like an expense would, except the account is now cost of merchandise sold. You will see here in the retained earnings column, the net of the two numbers is entered. A sales invoice. You may have seen a sales invoice when you purchase something. It has a lot of information on it. Who was the seller? Who was the buyer? The date shipped, terms. Very important information. The price, how much, all of that. Something that you need to look at is the credit terms. This happens, you have credit terms when something is sold on account. Now remember, if I sell something on account, I now have an accounts receivable. Many companies have a significant dollar amount tied up in accounts receivable. And when it's sitting in accounts receivable, they're not getting their cash in. And they need the cash in order to be able to purchase other merchandise, pay their expenses, etc. So many companies will offer a discount so that it encourages their accounts receivable customers to pay quickly. In this case, the terms are 210 net 30. What this means is the buyer, if they pay their invoice within 10 days of the invoice date, they can take a 2% discount. The net 30 means that the net is due by the 30th day after the invoice date. I want you to note, it's not 10 days plus 30. It is the first 10 days of the 30 days is the discount period, 30 days in total. Terms vary across the board. It might be 110 net 45 or 210 net 45. There's a lot of different terms, but if you learn to look at them, you can understand what they mean. Here's an example. Now, the customer's order date was May 29th. The terms do not start on that day, and we know we don't record the sale on that day. We record the sale on the date that the invoice is produced, June 3rd. That's also the date that the terms began, the invoice date. So the discount period goes from the 3rd through the 13th, and then the total credit period goes through July 3rd. Okay, so we had a customer who had a credit sale of $1,500. They paid us within the discount period. We got $1,470 in cash. Now, if we took that same amount and credited, or decreased our accounts receivable by $1,470, that would appear that the customer still owed us $30, but they don't. They've paid us in full based on the terms of their invoice. So we need to decrease our accounts receivable for the full amount of their invoice. But we also know that $1,470 and $1,500 does not balance. So once again, we're left with that. What do we do with the difference? Another new account, sales discount. We're going to reduce our retained earnings by $30, and that will now appear on the income statement in the line item titled Sales Discount. And with that, we balance in our entry. Sales returns and allowances. Customers buy things from us, but they also return things from us. In this case, we have the return of a video graphic card. How do we account for this? In this case, we're going to reduce their accounts receivable by the $225. We were told that the cost of the merchandise was $140, so we have to add that back to merchandise inventory. Well, now we have that whole question of, okay, so what else? We're going to record a minus to sales returns and allowances. That's going to reduce our retained earnings. And we're also going to put back into cost of goods sold the $140. That comment didn't quite make sense now, did it? Cost of merchandise sold reduced retained earnings when we sold the merchandise. In this case, because the merchandise is coming back in, it's going to increase our retained earnings, so it's put in as a positive number. The net, the difference between those two, is a decrease to retained earnings of the $85. I can tell you it's very difficult for me not to say debit and credit. That's my accounting background, I guess. So please bear with me. Now, we've learned how to sell merchandise, but before we can sell merchandise, we have to buy it. So let's look at the accounting for purchasing merchandise. We'll be using a perpetual inventory system, which is what we were using with our sales transactions. You can buy merchandise for cash, and this is an example of that. We're reducing our cash and increasing the merchandise inventory account, which is an asset because we own the product until it is sold. And you notice there's no entry on the income statement because at this point we're just buying merchandise. Now, excuse me, I'm going to flip a page up here. Okay. Let's assume that we had bought merchandise for $1,500 on account, meaning we would have had an accounts payable. Does this look a little familiar? Remember, we had a sales return. Now we're looking at the purchase side. I'm sorry, I said that incorrectly. We had a sales discount. Now we're looking at the purchase discount side. Please forgive me. I'm looking at two different things here at the same time. All right, we're going to pay for our purchase on account. There was a discount period. So all we have to pay is $1,470 of the $1,500. We're just looking at the same transaction from the opposite side. If you remember when we did the receipt of the money on the seller's side, we had an account that we used called sales discount. I want you to notice here, we don't use a purchases discount. Everything involving inventory runs through the merchandise inventory account. So although we owe $1,500, we're taking advantage of our discount and only paying $1,470, and we're going to reduce the cost of our merchandise inventory by the $30. Nothing on the income statement. So it may be in your best interest when this lecture is over to go back, run through the PowerPoint, and look at the differences between the seller side and the purchaser side. Purchases, returns, and allowances. All right, I am returning. I either had damaged product or incorrect product, but it's being returned. For the purchaser side, we're going to reduce our merchandise inventory and we're going to reduce our accounts payable by equal amounts. There are no entries on cash flows or income statement because neither one involves either cash or an income statement account. When a company purchases items, more than likely there's going to be shipping charges involved. How those shipping charges are paid for and the meaning to inventory is very important. FOB shipping point and FOB destination. FOB stands for free on board. If the freight is listed as FOB shipping point, as soon as the merchandise leaves the dock, is put on the truck of the seller, the purchaser owns it, and the buyer pays the freight. If the shipping terms are FOB destination, then the seller owns the product until it hits the dock of the buyer or the purchaser. At that point, then the buyer owns the good, and in that case, the seller is paying the freight. Just remember, shipping point means the buyer owns it and pays the freight. Destination means the seller owns it until it gets to the buyer and the seller pays the freight. All right, now we're going to look at a company that bought merchandise on account, terms FOB shipping point, and they paid the freight immediately. So the only part that's on account is the $900, but all the costs involved include the freight. So we're going to decrease our cash, increase our merchandise inventory by the cost of the merchandise plus the freight, and increase our accounts payable. Sales tax generally comes into play when selling goods to the final user, the consumer of the goods. Most states require sales tax on products. When a company has sales tax and makes the sale, the extra money that they're collecting over and above the sale price for the tax is not their money. That money belongs to the Department of Revenue. It becomes a liability because they owe it to someone else. And we have to collect that information over the course of a month, a quarter, so that we know how much we owe in sales tax and can make the payment. Merchandise transactions, the yin and the yang of the accounting world. They're mirror images of each other. For every purchase, there's a buyer. For every sale, there is a purchaser. So you have to look at them and see how they complement or mirror image each other. Remember, when it's purchases, everything runs in and out of the merchandise inventory account. Freight, those are transportation costs, as well as your cost of the product, your sales discounts, your purchases discount, and your purchases, returns, and allowances. On the sales side, we have line items on the income statement for sales discounts and sales purchases and allowances. So be careful. Company A records a sale, Company B records a purchase. Both sides of the coin. Merchandise shrinkage. Oh, I love it. No matter how careful a store is with their product will either get damaged, will be stolen, or will become obsolete. That's called merchandise shrinkage. It's a nice term, isn't it? So every so often, every store, even those on perpetual inventory systems, must do a physical count of their inventory. So they count their inventory, and they find that we have $62,150 in inventory. But our books, that merchandise inventory account, the balance in that account is $63,950. Obviously, there's been some shrinkage. There's $1,800 in shrinkage. Now think back. We have said that our financial statements must be accurate, timely, and usable. Well, if we present a balance sheet with this $63,000 number on it as our merchandise inventory, that is not accurate. So we must adjust that in order to provide accurate financials. The entry looks like this. We're going to reduce our merchandise inventory and reduce our retained earnings. And we'll use that same cost of merchandise sold account, even though in this case the merchandise wasn't sold per se, but it is gone. With the new income statement that we have looked at, we're going to now be able to do some new ratios that we haven't talked about before. We're going to look at gross profit percentage, average markup percent, and ratio of sales to assets. Think back to the income statement, the multi-step income statement that we looked at. Gross profit was recorded as net sales less cost of merchandise sold. So to calculate your gross profit percentage, you're going to divide your gross profit by your net sales. Average markup percent, how much are we marking our goods up? Remember those common size financial statements? These numbers are very important when you're looking at comparisons to industry standards or from year to year. So the average markup percent is gross profit divided by cost of merchandise sold. Here's a sampling of some information from Walgreens. Their gross profit percentage in both years was very similar, well, was exact. Their average markup percent was slightly less in year one than year two. So they have remained very consistent in their sales and in their markups. Ratio of sales to assets. Are we efficiently using the things the company owns to produce sales? Are we using all of those fixed assets that we've bought? Are we using other assets to manage our sales and to generate as much sales as possible from those assets? To calculate the ratio, you divide net sales by average total assets. How do you find average total assets? You take the assets at the beginning of the period plus the assets at the end of the period and divide by 2. Here's the information for Walgreens on that ratio. Now you'll see that the ratio was down in year 2. Does that necessarily mean that they are not using their assets appropriately? No. That you'll have to look further. These are just numbers. Perhaps they've purchased a lot of new assets, so their total assets is much greater than it was in the year before. There are many, many reasons for this change. We did see on the other two ratios that they've remained very consistent in their sales, so you would have to think that the ratio going down in this section has to be from something other than poor management. But again, numbers only lead you to ask more questions. They don't tell us the whole story. And that's the end of Chapter 4. And before I close, I need to make one comment. I was calling our balance sheet that we've looked at, the new one that we've looked at, a multi-step balance sheet, and that is not the proper term at all. I don't want to leave you thinking that I used the wrong words. It's a classified balance sheet. Yes, it is multi-step because there's various layers within that balance sheet, but the proper title of that is classified balance sheet because we're classifying our various assets and liabilities into different areas. Okay, that's my hiccup for the evening. If you have questions, of course, please post them on the discussion board. Thank you.